Hey, welcome to the podcast, everybody. Today's March 13th. Market is closed and for the most part is red across the board. If you're just tuning in to the markets and you haven't even looked, the Dow Jones was down 231 points today, about 1.5%. The S&P down 21 points. The NASDAQ was down 63 points, and the Russell 2000 was down also about 1.2%. Of course, on the flip side, interest rates went down as the fear trade was on, so we have that shift of out of stocks and into bonds. So we saw stocks go down and bonds rallied. Hey, before we get going, I did want to let you know, if you haven't seen, we've got a weekly radio show on Saturday mornings at 7 a.m. You can stream it live at KLUP.com or on an app. You can also always look at our website to play the replays. And it's just audio. Some people are saying my screen was black. It's just audio. It's a radio show. If you want the video, that's what this is for. That's what the podcast's for. But we try to do that on Saturdays. Try to do the podcast during the week, and then of course articles throughout. As I mentioned recently, we are doing a new website. It is probably about 50% done. So hopefully, maybe by the end of the month, we will unveil that new site. Everything will be much more consolidated. All the archives of the shows will be on there. It'll just flow a lot better, and you'll be able to see all the recent articles and all in one place. All right, well, let's take a look at the stock market. You know, we're hearing the 1929 comparisons once again. I guess we'll hear that the rest of our lives, that the market's about to crash. And look, I want to be clear about this. The stock market, when we saw it in 2011, corrections, which is up to 20%, can happen very fast, very quickly, and really for no reason. Everybody wants to put a reason on why the market is starting to fall. Is it China slowing down? That's probably the biggest headline and probably some of the rationale for why it's going down. It's probably valid. But markets just go down sometimes, folks. People just get in the mood to sell. That's why they ebb and flow. I mean, nothing major changed from here to here. Nothing major changed from here to here. Right? But it went up for 10 or 12 days in a row, and then it went down for 10 or 12 days in a row. Then it went back up, then it went down, then it went up, then it went down, looked like the world was ending, recovered all that, and then some, and now here we go. Okay, so it's just going to ebb and flow. Don't let it shake you out. But you need to be tactical in some of your portfolio, and this is extremely important that, yes, you may want some money in stocks or bonds all the time, whatever percentage that is. But you also need to have a portion that's tactical, meaning it can get more conservative as things get dicier. Perhaps it has the ability to be short certain areas or sectors. So you have to have the strategy that's tactical, meaning you make maneuvers. Yesterday, we went in and bought a little more precious metals, a little more gold. We bought some gold mining stocks in our aggressive strategy. We bought some gold mining stocks, and those did very well today. So that helps offset some of the things that you want to hold that maybe were red today, because there were things that were red today, that meaning they were down on the day. So you have to have this dynamic portfolio that is flexible. We talk about that all the time. So here's the S&P. We know we're getting this zigzag, and are we zagging or is it zigging? We're doing one or the other. Whatever this was, maybe we're doing the opposite. You know, again, where do we come down? This particular drop fell more than most thought, including myself. Went down a little bit further, but we didn't do much about it. Market bounced back. It was a correction. I think this will ultimately be a correction as well. Now, there was two things going on today, I think, that at least turned the market. You might remember we opened higher. That's what this is right here, and then we sold off pretty quickly. There's some tension overseas, obviously, that could have escalated a little bit. We got some more China data that was a little weaker. So that may be the reason why things turned. Again, as I mentioned, it could just be that people are just in the mood to sell. You know, things have been going up and they're ebbing and they're flowing, and it's time to sell. But I want to be clear about China. China may be slowing down. I wrote an article on Monday talking about their exports and how their exports look like they're falling off a cliff. And so immediately people jump to conclusions and say, well, the whole world must be slowing down drastically. And it could be, okay? I don't want to say that the economy may not be slowing. It's just that I don't think that indicator tells you that, okay? Because what's happening is we're seeing a move from China manufacturing to other places around the world, and mainly the United States and Mexico. See, back in 2005, you basically, if you're a U.S. manufacturer, you had your stuff manufactured in China because it was about 50% cheaper. Now, it's only about 30% cheaper, generally speaking, okay? And in Mexico, the cost of labor is actually at parity, meaning the cost to manufacture something from the labor standpoint is just as expensive in China as it is in Mexico. So for a U.S. company, where are you going to have your stuff manufactured? Probably Mexico, not China. So the fact that their exports are dropping, I think, is in large part to that. They could also be slowing. So don't misunderstand me. I think they may be slowing. I mean, there's a lot of data suggesting that. We saw some more today. But don't look at that indicator and assume the whole world's slowing just because China is. China could be slowing for other reasons. Okay, but we could be slowing as well, but those things aren't necessarily linked. Okay, there's a lot of other indicators to look at, and there's some more that came out today, but definitely that's affecting the market, and we see a little bit of a pullback here. Again, the question is, where do we stop? Look, there's no reason to believe that the 100-day moving average, which is the purple line, is your support, or this new bottom end here, because remember, we fell below the 100-day, and then we bounced back above it. But if that's the case, how far down do you have to go between where we are now and that line? Depending on how fast it gets there, is another 3.5%. So you could be looking at a 5% correction to get down to that support level once again. Again, maneuver. We took some profits in one stock yesterday, bought some gold mining stocks, so we made a nice move there because not only did we not lose that money today in that particular stock, but we bought something that actually was green on the day. And speaking of green, really what's happened in the last couple of days, 2-3 days, has been things that are benefiting from rates going down are working. Obviously, treasuries were up today. If you own 10-year treasuries, 1.35% up if you owned the bonds. Okay, the rates are now down to 2.65, and we're real close to a breakout. So you have to watch that because we're all thinking that rates are going higher because the economy is stabilizing a little bit, housing's been picking up. But if the fear trade continues, then rates will go down, meaning prices of bonds will go up. So we're seeing that work. I mentioned gold. We've been long gold, but we're actually got longer yesterday because it paused, looking for a pullback, never happened, started to break out, and it's breaking out here again. In addition, take a look at utilities. They were actually a stock group that was up on the day. So utilities, after having a horrible May and June and July, really last year, they went down, about 15%, we'll call it, and then chopped around. They've been working their way higher as rates have now stabilized. It's not a cheap group, though, but you are getting a 3.5% yield, and it's working. And there was a lot of volume in there today. You can see down here, volume was coming into utility stocks. So utilities worked, REITs held up, things like that. The volatility index spiked up. It was up about 12% today. This is the fear index, but it's really not only this indicator, but the way I measure it isn't quite there yet. And I put that out on Twitter today in quotes, there meaning at a place where we would say, let's rush in and buy. We have history on our side to say, hey, this is the spot. These little places here are where you go and buy stocks if you are in the same type of market that we've been in, which means we're not there yet. Okay, now that's one way to look at when do I buy if you're looking to take advantage of the sell-off. When do you buy? But there's also an indicator I watch. It's called our ECM Fear and Greed Indicator, and it's not quite there yet either. We want to see the spike. We want to see fear start to subside a little bit, and obviously fear is just now starting to build. So we wouldn't be in there rushing in to buy anything right now. And there's things that you may not want to own, and you may have to get stopped out of those as well. And that's fine. That's all part of the game here. Some things are trades. Some things are investments. And the trades are things you may want to either take profits on or you may want to get stopped out, depending on the situation. But obviously those investments, you have to decide if it's an investment, meaning you're going to keep it longer term, going to ride through this, or you're going to hedge it some way in some fashion, whether it's puts or whether it's an inverse ETF. There's lots of ways to do that, but you have to decide that. So getting back to the stock market here, let's take a look at the Russell 2000. You can see it actually went up to new highs, pulled back a little bit. So now we've got essentially 6 out of the last 7 days have been down. Not a bunch, but they have been down. So let's watch that. Kind of a similar pattern to the stock market. One thing I think to keep an eye on is Treasury inflation-protected securities. Remember, we have certain indicators, maybe in securities, pointing to a little bit of inflation. How can we have inflation if the economy really is slowing? Could it be stagflation? Maybe. But tips are starting to percolate a little bit. So watch these if they are to break out. If they break out, that could be a nice trade. Not a huge moneymaker, but something that would be working in a down tape that would offset some of these stock positions that you want to keep. Okay, so that's a wrap for today. Thanks for joining me. Appreciate it. Keep watching the website because it's going to be changing. And if you're not subscribed yet, just click the button on the right top there, and it will subscribe so you can get these via email. Okay, and if you have any questions, don't forget Carl@EggersCapital.com. I'll email you back. Thanks a lot. Appreciate it. Have a wonderful evening, everybody.